My talk now is how to achieve consistent performance. And I think the key word there is consistent. I know as an investor, a lot of times we're rocking it along and we make some money, we're feeling pretty good, and all of a sudden we have that one trade that just pulls us down. And it just wipes out any gains we've had for whatever period of time, and it can be very disheartening. We want to move from being inconsistent to consistent, and that is what's going to keep you on the right path, keep your confidence up, keep you in the market, and have consistent returns. And the easiest way to make consistent profits is to start with a simple but effective trading plan. It doesn't need to be complicated to be good. I mentioned that earlier. If you Google search trading plans, you're going to get hundreds of thousands of trading plans, but they don't need to be that complicated. But I do find that they're better in writing. In a previous life, I taught Weight Watchers on the side just to kind of keep me on the straight and narrow. It was just a little part-time little thing that I did to keep my weight in check. And when I was working with clients there, I could tell you the people that were successful on the program were the people who wrote things down. They had their goals written down, and they also had their food plan down, and they wrote down what they consumed. Trading as well, it can be emotional. So you're much, much better off if you have a plan and then you trade following the plan. First of all, you need some basic understanding on guidelines to build your portfolio. And these are fairly simple, but it's worth a reminder just so that you stay out of trouble. Now let's start with the top one. Use a dollar-weighted system. Okay, the dollar-weighted system. You know, that old saying, don't put all your eggs in one basket. A few years ago, when I was fairly new with VectorVest, I took a call in product support, and the guy was so upset. Any of you remember Green Mountain Coffee? I think it dropped maybe 35-40% in a day. And he called me. He had all of his investment in Green Mountain Coffee. All of it. 100% of his nest egg was in Green Mountain Coffee. He said, my wife is ready to divorce me. I went, yeah, I get it. I get it. So I put on my teaching hat and I go into this dollar weighting, you know, you got to diversify, blah, 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 blah to him is what he was hearing. He said, no, you don't get it. I want you to help me find a stock today to make it up tomorrow. I said, so basically we're going to go to Vegas and just double down, right? And really you got nothing to bet at this point. So we certainly want you to use a dollar-weighted system. We were showing you on those portfolio summaries, and I hope when you go home, if you haven't already, build a portfolio of the stocks you own and look at that diversification graph. Look at how many industries you're in. Hopefully you're in industries that are rising. You just don't want to be overweighted. Think about if you were all in petroleum a couple of years ago. You know, petroleum's trying to make its way back up. What if you were all in airlines and the price of fuel goes up? Just think if something catastrophic happens in one industry, you just don't want to have that be systemic and run through your entire portfolio and bring it down. So you really need to do that. Sometimes there's a psychology in investing too that investors think if they're familiar with something that it's safe. They want to be all in on what they think they know. Well, I lived on Lake Norman, just north of Charlotte, beautiful community, beautiful 500-acre lake, living on the lake. And one of my neighbors was a top executive with one of the banks. So he had been with the bank so long, he had a lot of stock options awarded to him through the bank. But then he took his retirement funds and put those all in the bank. And then it hit. Now this has been a number of years ago. But let me tell you, that was life-changing for Fred and his family. It's taken him a long time to make that up. So we don't want you to make that mistake. You need to be dollar weighted. Don't think that because you know something, you're not working at these companies. You don't know what could happen. Could the CEO be taken out in handcuffs? Could something happen? Absolutely. So we don't want it to be a catastrophic loss for you. So remember to dollar weight. Actually, the end of the year, I try to do that before the end of the year because I always look to see if I should do some harvesting of profits, or even if I've got a loss, should I harvest that and take that money and deploy it into something that can be more profitable. Even though we're into the new year, you know, tax laws are changing a little bit. We're all a little bit uncertain about what will happen, but always be aware of not having too much money into one stock. Which brings us to holding 5 to 20 stocks. You know, how many stocks do you want to hold? Now, I did a little bit of research and I looked at Investopedia. I love that website if you guys aren't familiar with it. Investopedia. It's like the encyclopedia of investing. They even, you can subscribe and they'll send out a term of the day, a technical term. It's a great educational tool. When I used to be in training for VectorVest, I certainly had that as a shortcut for all of the new employees. But, you know, it said that most investors, either professional or just retail investors, hold anywhere from 15 to 20 stocks. The more stocks you hold, the more diversified you are. That way, if something happens, it's not going to run through your portfolio. You've got less risk by mitigating having all your stocks in one. A lot of people say, I don't like that because then I have all these transaction costs. But I don't think that's a valid argument anymore. You know, we've got the Ally Invest. We've got all these interactive brokers. The cost of trading has gone way down. You know, if you don't have a reasonable trading cost, I say either move your account or first off, call your broker. They will negotiate with you. I remember the days when trading, I'll really date myself. I used to work at a bank that was beside A.G. Edwards. It was a trading company. And the traders actually would either call or either go into the office and sit there and watch the ticker tape and then place their trades. Well, those trades cost, what, $50 or so? Do any of you guys remember that? Cost a lot of money. The round trip cost was considerable, which made you afraid to get out of a trade. But I don't think that's a valid point anymore with the cost of trading. You can get out too easy. $4.95 to keep you out of harm's way is not too much to pay. So consider that as well. I did have a client call, and she was a private investor managing just her own money, and she had 65 or 70 stocks. Now, that's a little bit much, but I will say this. Now that you have VectorVest and you have our tools, you've got the Genius working for you, you've got RoboTrader working for you, you've got some tremendous stops in this system that you don't have anywhere else, that it makes holding more stocks easier. You've got a quick way to analyze stocks. You can build a watch list of your stocks, even if you're not watching them. I used to say, give me Saturday morning and a cup of coffee and look at the graph of your stocks that are in your watch list. And as Ray sorted them, don't worry about the guys at the top. It's the guys at the bottom sorted by RT that are going to pull your portfolio down. He talked about weeding the garden. You know, it's the troublemakers at the bottom that you need to address. So don't be afraid to do that, you know. And then if the color guard is right, telling you to buy, redeploy that money. You know, I told you my fiance was married to GE. You know, instead of, you know, he's congratulating selling it even though it had dropped quite a bit. Now he's calling his broker asking if it's a good time to buy. I'm like, seriously? Out of 7,600 and some odd stocks, don't hang on to these guys that have caused you angst in the past. I think we can find a better mate than that. So don't let that lock you in either. Now, if you have a gain and you're, or if a position comes open, when you get ready to deploy, make sure you look at the value in your portfolio and make sure it's weighted. Deploy it so that you're not, again, heavily weighted. Just because you have one position maybe close out at a nice gain doesn't mean you take all that money and go buy one stock. You may need to buy 2, 3, 4, whatever it takes so that you're balanced in your funds. You don't want to get that basket or the pie chart. Remember the pie chart. Make sure the slices aren't too big in any industry or any stock. So here's those money management. Diversify in when and what you buy. In when you buy, do any of you go to the swimming pool and just cannonball into the deep end? Some people do. I don't. I love warm water, so I dip a toe and then I wade in a little more and get to my knees and my waist and then I get on in. And I'm a little bit that way with the market. You know, it's rare that I go all in. So consider that. We showed you in our tool just a moment ago that you can tell the system when you're testing or in any of our settings in the Genius either to buy all your positions at one time, or if you want to be more prudent, leg in. Just wade on into the pool. Choose maybe one or two stocks. And here's the thing. Let's just say you're going to be aggressive and you want to buy on a green light. The first green light. Now, if you want all the money there is to be taken off the table, you might buy 10 stocks. But if you're someone a little bit more prudent, you might buy one or two. Hold those. Wait a day, see if the signal holds. If it holds, then maybe you buy another stock. So as you're getting those lights, you're going to leg into the market. If the light doesn't give you that signal the next day, you don't panic. You just take your foot off the gas and coast. You wait for the signal to allow you to go back in. So that's a prudent way in diversifying when you buy. I like looking at portfolios where I see, different purchase dates. And some of them are in the, especially in our long-term winners, they're going to be in your portfolio for a long, long time. And speaking of that, letting your winners run and cut your losers early. I went over the profit locker. There's not a better tool out there. There's tools out there that compete with this that don't work exactly like this, that sell for thousands of dollars. So on a competitively priced basis, this is a fantastic tool for you to cut down those losses. And as I said earlier, cutting down on losses is key to money management. Key. Because it not only affects your bottom line and the amount of money you have to deploy, but it also gets into your head. So don't let those losses get away. The winners run. That's sometimes, that greed factor, but the profit locker, I think, is the key to that. It's going to let it run. You get a reasonable gain, and then it's not going to let you slip back too far. So learn to let the winners run, but cut the losers early. The next thing is never risk more than a 1 to 2% of your total portfolio value in any one trade. So think about this. If you had $100,000 in your portfolio and you didn't want to lose any more than 1%, how much is that? It's a math test. See if you're awake. $1,000. So if we don't want to lose more than $1,000 on any one position and we had 10 stocks, then we could have a 10% stop loss. So we have 10 stocks, all $10,000 investments, and we're only going to lose $1,000 on that. So that will help you as well. If you've got more stocks, sometimes and depending on your risk investment and what type of stocks you're in, you might take a little bit higher. So let's just say if you had 2% loss, that's $2,000. So you could up your stop loss to a 20%. So make sure you adjust those to the size of your portfolio and the percentage. But we don't recommend really going over 1% just to be prudent. 2 to me is the high end. So don't let any one position wipe you out. So do that when you get home. And the profit locker, again, is a perfect tool for that. I do want to show this next formula. I loved algebra. Not really. I'm lying through my teeth now. This is a formula to help you decide on what your stop should be. So in this formula, the S is the stop loss percentage. How much are you willing to give back? It's dependent on the percentage risk on any one single position. Well, we said below, we like to keep it at 1%. So this, if you're going by our recommendation, would be 1 times the number of positions you hold. So if you're holding 10, that's 10 That's your percent times the number. That would be 10 divided by the percent capital employed, because that affects. We are not always 100% into the market. And that's the beauty of VectorVest. Sometimes we tell you cash is a position. I was with Dr. DeLito in Vegas, I mentioned a number of years ago, and he said, we're probably the only people out here in this whole money show saying don't buy anything. And that's, we want you to be successful and make money in the market. We don't make money by you trading. We want you to make money in the market overall. So think about how much, if you've got less of your capital employed, then you can take a higher percentage. So if you had 50% of your capital, you could have a higher stop loss. So I ran a couple examples. If you had 10 stocks and 75% of your capital was deployed, that'd be 13%. If you had 15 stocks, 75% of your capital is deployed, that moves you all the way up to 20%. Now, that you could get this number very high, but remember, don't let it get too much on any one position. 20 for me is pretty much a fair number. Don't want to get more than that. So just use that percentage. Look at your investment portfolio. The portfolio itself, when Ray was talking about building your portfolios, you make a deposit and it will show you your buying power, how much cash you have in there. So use that as well. Last but not least, you need to know, we said this earlier, this is VectorVest. You need to know when to buy, what to buy, and when to sell. If you can know those three things, you'll be fine. When to buy, we've gone over the market timing graph. We've gone over the color guard. We've gone over the market timing signals. If you're aggressive, even if we talked about having baskets of funds. I talked about I manage my daughter's money a little different, so I'm more aggressive with her a little bit than I am in my retirement funds. So just remember, use the signal based on your timing. I will run through these if you want to grab a pen and write these down, and I'll give you the fastest to the slower signals that we typically use. Can anybody tell me our fastest trend indicator? They are awake. Good job. The primary wave, that's our fastest signal. The primary wave is reflected on the home page. And in fact, we can move over there if you don't mind, Ray. We'll go into the program and show you. It's on the home page. Remember, basically everything you need to know is on the home page. Notice him stretching those. Each one of those items is a gadget you can resize. So on the home page, you're going to look to the color guard. The first component in the trend column right here says up. That means the price of the VVC is higher than 5 days ago. It's our fastest, most aggressive trend indicator. I'll talk about that next in just a minute. So that's our fastest signal. One thing to note, we've had a lot of green lights. We've had all these good signals coming up. When the primary wave, you're in a confirmed up call, we're in an up situation. That second up just means the underlying trend of the market is up. The MTI is above 1. But if I'm in an up situation and I see it go to down up, what do?
Stop buying.
Stop buying. Just throttle back a little bit. I call it the primary wave, the ripple in the ocean. The confirmed calls to me are the big wave. That's our slowest, most conservative signal. That's the big wave in the ocean. The market has shown that the trend is sustainable and it's confirmed by the buy to sell ratio. The primary wave is the start of that trend. It's the first week. Because when Dr. DeLito was looking at market timing, when he saw the market went up over a week's basis, he said that's the start of a trend. If it went up that second week, it was sustainable. So that primary wave to me is that ripple. So if I am in an up situation and I see the primary wave go down, I take pause and see what happens and wait for it to go back up, because it could be the first signal that the tide is turning in that ocean. So that's our fastest, most aggressive trend indicator. And you'll see it in the trend column, first component. And we'll also give you that information, of course, in the daily color guard report. Okay, our next fastest signal is the green light buyer. Not with a kicker, without the star, it's the green light. To get a green light, we have to be higher day over day and week over week and not coming from a red light from 5 days ago. That's how we get the green light. So that's our next signal. I've seen the primary wave go up. Now I see a green light. I'm starting to know things are going my way. Things are good. Higher day over day and week over week. And not coming from a red. If there is a red light there from 5 days ago, it doesn't matter if the market blasts it off. It could gain hundreds of points. But as long as there's a red light from 5 days ago in the price column, there's no way to get a green. It slows it down. It protects us from being too fast on the throttle. So green light, higher day over day, week over week. That's the second signal. Now we ask about, this green light did not have a star, and the one before it. As they went over in market timing, not all green lights are found to be the same, Dr. DeLito found. The green lights that are confirmed by moving averages of relative timing are stronger. You get the 10 above the 15-day moving average of timing, so we're not only getting a green light, but momentum is confirming our way is up. So that's when these green lights with the stars start flashing. Just know that those go on at the end of the day. If you're in real-time data and you see a green light and there's not a star there, you won't see it until the market closes. Of course, you could go look at a graph just to see what those are doing, to see if it's still continuing. And if it holds through the end of the day, we'll put that star there. So that's our next signal. And I love that signal. It gives me confirmation that I've got some momentum. The next is the DEW. I don't think we've talked about it too much. We've used it. If we go to a graph and pull a market timing graph, we haven't really talked about it, but we'll change it to the layout and we'll choose, let's use the Enhanced Pro Trader because this is,
Can we show them this real quick?
sure, we can show, Ray's saying, can we show them the GLB RT kicker? Let's make it 3 months to make it a little bit easier to see. Notice that these lines are hard to see. You can change those. All Ray has to do is right-click on the item that's in the parameter column, and he can change the style. And you guys can just paint away. Choose a color that you like. Made that easier to see. So we have a green light in the price column, and the 10-day moving average of relative timing is above the 15-day. And that's how we got that signal. That's an up signal. We went to a neutral. And if we remove that high, sometimes signals are lost behind the high lows. Actually, this green, if we hover over this green without a date line, it'll show that green runs all the way. I think the date line needs to be off. Oh, there we go. That shows that green light with the kicker is in place. So if you wanted to check it throughout the day, you could, but in fact, on the graphing part, don't let this mislead you at time. Look in the parameter column to the values to make sure that they are there. That date line is when we didn't have the kicker. So that we would not have had. If we go over to a kicker up, the 10 has to be above the 15. If they're both at, say, the level of 1, you won't see the kicker. There needs to be a crossover of it. Okay? All right, the next signal, actually we'll just look at the Pro Trader timing DEW. This is a technical study, and we'll change the signals on the graph. The D is, again, it's an acronym. The D stands for the D-trended price oscillator. The oscillating line of 0, any move to the upside above that 0 line is a bullish indication. Below it is bearish. I used to call it blue sky or deep water. We like being up in the sky. We want to be able to breathe. So that gives you that oscillator. And these factors, I mean, the parameters are listed here to the right. So that's the first. The E are the envelopes. They're above and below the vector vest composite price. They show the normal range of trading. And it's extremely rare that the VVC pierces those. I don't think it's happened since maybe 2011 is the last time I've seen the envelopes pierced. And then the 30-day weighted moving average is the W in the acronym. You can barely see it, but it's floating here in the candlesticks. So there's the D, E, and the W. The signal requires two things to occur. To get a DEW up signal, the DPO must be positive, so that moved into positive territory, and the price closed above the 30-day weighted moving average. That's how we got the up signal. Now we did get a little bit of a whipsaw here on this down signal, so that can happen. The down signal came because the DPO went negative and the price closed below the 30-day weighted moving average. If only one of those things had occurred, the signal would not have changed. Now, if there is a rare piercing of an envelope, that can take the place of one of those items. But again, it's extremely rare that we see those piercing. Piercing would mean, let's just pull it back to 2011 and see if we can find it. See if we can find a pierce. I think there was one in 2011. There was a piercing. So we got the DEW up signal. Price went above the 30-day weighted moving average, but the DPO had not gone back positive. But because the envelope had been pierced, we allowed that signal to be given. But again, it's not often that you'll see that happen. The DPO was recovering, but it had not crossed above the oscillating line. So when the price came back in the envelopes and went above the 30-day weighted moving average, because that envelope had been pierced, we allowed the up signal to occur. This is a really good timing signal. I think when we looked at Model Portfolio 3, that's the timing signal that it's used. I actually like this graph layout. Sometimes I use it for stocks. You'll really see the envelopes pierced. Think about, the rubber band, anything that's stretched too tight. Things retrace to the mean. If a price gets too high, it'll come back. Price gets too low, tends to retrace back to the mean. So it's a really good layout and a very good timing signal. And then last but not least is our confirmed calls. And we can use that just on the regular market timing graph. It's our slowest, most conservative timing signal. You're either in a confirmed up or you're either in a confirmed down. There's no in between. You are or you're not. So the last thing I want you to do is go look and say, hey, I'm in a confirmed up signal, but what do you got to be aware of even in a confirmed up? Primary wave turning down, red lights coming in the price column, those type things. I don't want you to go against the market. Yes?
If you haven't had it confirmed up in a while, is it best to stay out till you get another?
The question is, if you haven't had a confirmed up in a while, is it best to stay out? Fresh signals tend to work the best. If you can get in on the first signal, they tend to work best. And we tend to run our back test going in on a new signal. But I know in investing you may have money deployed and you can't always do that. But just pay attention, as we say, what's going on in the market. Even though you're in a confirmed up call, that's our slowest signal. We could be days away from getting a confirmed down. So watch to see if the primary wave is down, if there's red lights in the color guard. Again, you've got a traffic light. It's great. You know when it's okay to go. When the market flips to the downside and you get red lights that are confirmed with momentum to the downside, that's when you can trade to the downside. But as Jim said, be careful. Pullbacks in the market and shorting stocks in a bull market is risky. The downturns don't seem as severe and they don't seem to last as long in a true bull market. So just be careful of doing those. So pick the timing signal. So the point of this is pick a timing signal that fits your investment temperament. And maybe do some back testing. Choose the GLB-RT kicker against the DEW. See if getting you in a few days earlier. In fact, this is a market timing graph for 1 year. Yeah, we're in a confirmed up. Let's just see if the DEW came any earlier. That was on November the 24th, my birthday. You write that down. It was. So this is the DEW. It came on the 16th. So it would have gotten you in a little quicker than had you waited for the confirmed call. If we had used the GLB-RT kicker, actually we would have gotten in much sooner. That was, what's the date there? August? No, I can't read the date. September the 1st. So that would have gotten you in even sooner. So it depends on how fast you want to get into the market. Primary wave first, green light second, green light kicker next, DEW, and then the confirmed call. Occasionally the DEW and the confirmed call, they'll fire on the same day. So just make sure that, if you're prudent, make sure you're using the signal that's prudent. The confirmed call, maybe the DEW might be a safer one. Yes, sir?
Yeah, the GLB is first, then the GLB-RT kicker. Which one's fastest?
The first one is the green light. The first is the primary wave.
Right.
The second is a green light, just a plain old green light in the price column without the star flashing. It's not confirmed that the moving averages of relative timing are confirming momentum. So that's 2. 3 is the GLB with the kicker. Then the DEW, then the confirmed call. Okay, let's go back to, actually, I'll let you stay there, Ray, so that we won't jump around. But in your slides it says next, what to buy. There's 7,000 some odd stocks. So how do you choose a stock to buy? Do you listen to the talking heads, Kramer? Do your brother-in-law, whoever tell you who to buy? We get so many newsletters and things. Well, at VectorVest, we can help you with what to buy. Again, Dr. DeLito will say on the home page you can make money right there. One of the gadgets on the home page shows how to make money with top VST vector stocks in that list. We also have top RT industries. Those are already the high flyers that I talked about yesterday. These are industries that have already made it up to the top of the list. So finding stocks, maybe buy 1 or 2 stocks from those top industries is a good way to go. We also have what's called Midas touch stocks. On Mondays, we go over the Huey, we go over the Gold Bugs Index, and we were using this wonderful graph layout called the Midas touch for that for years, and then we realized it works very well for stocks. But that graph layout has very specific criteria. Let's go back to a graph tab, and we'll go to a stock graph. Mira, what's a symbol? I'll pick on you. What's a stock symbol? Costco? Yeah, they get enough of my money. Can't get out of there for under $100. It's a rule. It's a rule. So there's a Costco. So we're going to go to the graph layout, and we're going to choose Midas Touch. And the key thing is to change the time frame to 3 months. There's a shortcut in the lower right-hand corner. We're going to look at 3 things. There's the price on there, but we could even take price off. All I'm really concerned about are these lines, and this is how it qualifies as either a Midas Touch or not. The parameters list, we have a 10-day and a 65-day moving average of the stop price. Stop. That's that 13-week adjusted moving average, a 10 and a 65. And below we have a 40-day moving average of relative timing. For a stock to be considered a Midas touch stock, all three of those have to be hitting new highs. So is this a Midas touch stock? Yes. Yes. Would that be a good stock? Yes. They're high momentum stocks. So when we first started talking about Midas touch stocks, you would have to go through one of your searches or your stocks and pull up the graph and go through and look at them. In fact, we could go to the Viewers tab and is this your watch list, Ray? I think it is. Let's just graph those all in the Midas touch and we'll see if any of those are Midas touch stocks. I'll give you the exam. Now, that's on a 1 year, so we had to change it on a 3-month. Is that a Midas touch? No. Next. Yes. No. No. Because this is Apple, and for those of you who really maybe can't see this too much, the moving average of relative timing is in a pullback. It's not hitting a new high, so that is no longer a Midas touch stock. So that's how you get that. But we've done the work for you. You don't have to go look for Midas touch stocks. We have a watch list. Ray was showing you how to build your own watch list. Well, we've got tons of watch lists that we've already built for you. In this watch list menu, under cherry picking, we have something called Midas touch stocks. And every evening after the market closes, development runs the software to pull Midas touch stocks. They have to meet that criteria, so there's no need for me to look at these graphs. I know without looking at the graph that these are Midas touch stocks. So that's beautiful. That's nice. So all of these, look at these great candidates. So we've done the work for you.
You consider those prudent or aggressive?
The question is, do I consider those prudent or aggressive? No, neither, because there's no criteria for those. However, in Unisearch, let's just say you want a good, safe stock. You go to a Unisearch search that you like that has that criteria, a high safety score, and we can filter by watch list. In fact, Ray, I think we have time to show them. We could even choose, we could do a new search. Oh, the settings are weird. Actually, let's just go down to long-term winners. One of the prudent searches we'll use that has some good safety scores to it. Searches retirement's fine. And do we have long-term winners or? Yeah. Okay. This is looking for stocks that are a buy and the moving averages and the comfort index is trending higher. We could add to this in the bottom parameter stocks, filter by watch list. Stocks, filter by watch list, equal to, and then we go up to the cherry picking. Don't put a check mark there. Click on the plus sign to open that up and then put the check mark in the Midas touch. So now when we run that search, it has to meet all the criteria of the search and it has to be a Midas touch stock. So a real easy way to include those high momentum stocks in your search, but having some safety to them. Okay? All right, so those are great places. We also have, just your top VST vector stocks. In the watch list, we have under the dividend payers, we have some DRIP watch lists that I absolutely love. Companies that have increased their dividends year over year for over 25 years. They're listed DRIP 10. This is 25 plus years. There are 112 stocks in the database. These companies have increased their dividend year over year for over 25 years. Is that something you would like? Yeah, so good place to shop. And it doesn't mean you have to participate in the DRIP, but I do like the dividend reinvestment. It's a great way. My daughter's grandfather left her some stock or gave her some stock before he passed away, and instead of taking the dividends, we've just reinvested the dividends for her. And it's made a nice gain for her. The Derby. I don't know how many of you have the Derby, but that's a great place to find good stocks. For those of you who do not have the Derby, remember to read the views or watch the color guard. Every evening we give you the 1 and the 5-day Derby winners. So that's a great place to start. But the Derby's a great tool. If you guys want to get a trial to it, let us know. It's a fantastic tool in of itself, but we also have the jockey club that you can attend and participate in, which is fantastic. All right, on your next slide, Ray, you can stay in the program. I'll just touch on a couple of things about when to sell. And I think I hope I've driven this home on knowing when to sell a stock. Have that plan in place when you buy it. If you've got a profit target, get out. If your stop loss is met, get out. When your trading plan calls for it, get out. And also, when we truly say you're in a bear market, doesn't mean necessarily ditch everything, but when a bear market is indicated, you'll hear Dr. DeLito, I look for certain words in his essays. Protect your profits. You guys that have been with us a long time, you recognize some of his phrases that key. Maybe you need to be very cautious, maybe take some money off the table. His essay from many years ago, Word to New Subscribers, contra ETFs, may be the time for you guys to learn to deal with the downside, entree to a long bear market, all those things. Just make sure that you listen to the guidance. And you guys now know where the market climate graph is. You know how to find that. It's on the graphs tab. It's one of the drop downs. All right, before I leave you, I'm just going to touch on following a portfolio. We've got a lot of those automated trading systems already built for you. Jim was showing you how just to click a trading system and follow it. These model portfolios, you can choose one of those. On the Views tab, Timing tab, for instance, model portfolios, you can choose the action plan. There's also some model portfolio videos for you to watch. But when you go into the action plan, depending on the trading system that you choose, let's just look at Model 3. Model 3 is using the DEW, and we've got a green light. It's saying it's okay to be bullish. It's okay to fill positions. And if you have empty positions, it actually gives you the stocks. It ran the search for you. If you already own the top one, skip it. If you own the second one, skip it. Go down to one where you're not duplicating in your portfolio. And this also tells you when to close them. So follow those model portfolios. And if you want to do more reading on those, besides the video, on the views under special reports, you can download our model portfolio guide. All right, the last slide says, our goal at VectorVest is to provide all the tools, training, and techniques you need to consistently make money in the market. You're not in it alone. I commend you for coming here today. It's my last talk, and I really do appreciate everyone's attendance. And, reach out to any of us. We're here to help. And take advantage of these new tools and techniques. A lot of resources have gone into these, and a lot of testing has gone into them before they're rolled out. We beta test them and we use them in the office, but these new tools that are now available, the Profit Locker especially, we hope you'll test those out and use them and help you be, as this topic has been, to be more consistent in your trading. But thanks so much for your attention, and yes, I'll take...
Profit Locker seem to provide a recommendation of a stop loss at 15%, and your equation seems to recommend 10. What's the right number?
The question is, what is the right number for the Profit Locker? Now, we were giving a 50% gain on the Profit Locker. Some of them had 100, some of them had a 20% loss. But again, that will be a personal thing. 20% loss is probably the max I would go. Todd, through his research, I believe, was a 50-15 gain loss. So and again, you need to also determine how much of your assets are deployed. But don't let those Just because you have a small amount of money, let's just say you have a very small percentage of your money into the market, don't open that stop loss too wide. That's just a general guide. 20 would be my max. All right, yes, sir.
How can we consider setting a profit target?
How can we consider setting a profit target? A lot of that will depend on the stocks themselves. If you see stocks that double year over year, then go ahead and set the 100. But if you see volatility, bring it down. Be sure to take your profits a little bit sooner. But again, the profit locker is smart enough to tighten that up as it gets close to your target gain. And as Ray showed, you can always adjust those stops. If you've got a nice gain and you really think that stock's going to continue to run, go in and adjust it. Yeah, just watch the behavior. Again, the graphs are like the DNA. What you see is what you get. You know, we don't know what's coming the next day, but look at patterns.